Four big banks reporting today. What's your rating on the banks? Do you have expectations that investors should be especially mindful of? I know it's a group of four, but give us a sense. Overall, what are your expectations?
Yeah, we do have buy ratings on the four banks reporting today, JPMorgan, Bank of America, Wells, and Citi. So I think our bullish base case really is that the economy avoids recession here, that the Fed is given credit for the soft landing. Credit quality doesn't deteriorate much further from here, and banks are certainly well reserved at this point. Lower rates will begin to help loan growth here, and by the back half of 2024, also ease some pressure on deposit costs and the securities portfolios. And we get some kind of a rebound by the second half in IPO and M&A activity. As you know, it's been a dismal 2 years for capital markets, and just based on a lot of pent-up demand. The first phase of the improvement tends to be a nice rise in equity valuations, which we had in 2023. So phase two should be better conversations and more companies looking to go public and acquire other firms.
All right, Stephen Biggar with a buy rating for JPM, Bank of America, Citi, and Wells Fargo. You mentioned two key things here, loan growth and also deposit cost. Together, you put them together, that's net interest income. What's your outlook for net interest income for these big banks?
Well, the fourth quarter is going to be largely down, probably around 10%. The exception to this rule will be JPMorgan, who acquired First Republic last May, and will have a nice bump in net interest income. So, but yeah, sequentially and year over year, there is those pressure on deposit costs has pushed net interest margins a little bit lower, and that's a headwind probably going as well into the first half of this year.
Big story last year were the losses that a lot of banks were taking on Treasury. We haven't talked much about it in recent months. What's the outlook when it comes to those at least paper losses when it comes to Treasuries?
Absolutely. The conversation about the securities portfolio has kind of diminished as rates have moved down. So that's put a good bump up. So I think that will continue to be the case. I don't think we'll hear much about that on the calls. And if long-term rates continue to stay a little bit lower here after peaking at 5%, I think that's kind of a non-issue for banks right now.
Is there one bank that you're watching that in your mind is going to be the one that's going to signal something to investors, either good or bad? And I also want to get your take on Citi announcing that they're taking that big charge.
Well, JPMorgan tends to be the bellwether. They're in so many different areas. They can give us a good read on the consumer. In particular, credit quality among the lower income consumers has degraded a little bit here, degraded. And you have obviously the capital markets, a weakness there. They have been showing some market share gains. So I think we'll hear something about the conversations being more constructive. So they just have their tentacles in a lot of different spaces. So I think that's the bellwether. With the exception, of course, of net interest income this quarter.